Now I'll explain something called as techniques of capital budgeting. So these techniques of capital budgeting, the basis of that will all depend on the cash flows. Totally there are 6 techniques of capital budgeting. 2 techniques are non-discounted one and 4 techniques are depending on discounted cash flow. When I say discounted cash flow, it will take into consideration time value of money. If it's non-discounted, it will not take into consideration time value of money. So instead of explaining the formulae, I'll straight away explain it with a question to you. So let's go through question 1. Please go through question 1. As of now, I'll explain the 6 techniques, then I'll explain the rules which are required. Okay. Now I'll explain this. So some company wants to buy some new machine. There are 2 models which they have talk about, which they are thinking about. The cash flows are given in the question. Let's get those various cash flows and then we calculate. Working note 1, initial outflow. Working note 1, initial outflow. Working note 1, initial outflow. Initial outflow, particulars and amount. Can you look at the question and tell me for model A, what outflow can happen on day 0, what inflow can happen on day 0 for model A? Outflows and inflows for model A. What is the purchase price of the machine? 5 lakhs. That is going to be my first outflow. So write capital expenditure, capital expenditure, capital expenditure, particulars model A, model B, sorry. How much the capital expenditure? Is it same for both? 5 lakhs. Point number 2, salvage value of old machine. You will sell this, so this is inflow of money for us. Capital expenditure 5 lakhs. All your outflows will be in brackets or negative, okay? So capital expenditure is outflow, minus 5 lakhs, minus 5 lakhs. Salvage value is inflow. How much is the salvage value? 1 lakh. 1 lakh. Any other item of inflow, outflow apart from that on day 0? Utilities, so cost of utilities, cost of utilities, what they have given in the question? $50,000 for machine A, outflow, inflow, outflow. Machine B, 1 lakh 80 of outflow. How 1 lakh 80? 2 lakh minus 20,000. So 50,000 Both are outflows. Net outflow. The net outflow for the machine is 4,50,000 and 5,80,000. Any doubts on the net outflow figure? Okay, now please listen. First calculation is your outflow, which is already done. The second calculation is for inflow. What am I going to receive every year? In this question, it is readily available. The cash flow after tax are expected to be year 1 1 lakh, year 2 1 lakh 50, year 3 1 lakh 80. So that's a readily available information. So I am not going to spend time on calculating cash flow. We'll understand how 6 techniques work. Major chunk of our problem will focus on calculating cash flow. This problem focuses on getting the techniques. So next to working note 2, calculation of payback. Calculation of payback. Now, payback as a technique does not consider something called as time value of money. So, according to payback, what you receive in year 1, what you receive in year 2, what you receive in year 3 can be added, can be subtracted. And the term payback means in how many years are you going to recover the amount which you have invested. Payback means get it back. So, machine A, our net investment is 4,50,000. On machine A, in year 1, how much I am getting back? 1 lakh. I am yet to recover my 4,50,000. Year 2, how much do I get back? 1,50,000. So 2,50,000 recovered back. Year 3, so 4,30,000 is recovered back. Yet to recover the money. Year 4, my recovery is done. Year 4. So somewhere in between year 3 and year 4, my payback is going to come in. Because in year 1, I have recovered 1 lakh. Year 2, I have recovered 150. Year 3, I have recovered 180. So cumulatively 430 is recovered and the investment was 450. According to this technique, year 1, year 2, year 3 can be added, can be subtracted. If you want, you can add it. If you want, you can subtract it. That is how the technique says. Now, coming to the calculation, please listen. Year, cash flow, cumulative cash flow, cumulative. Cash flow, cumulative cash flow, this is for machine model A. And that is for model B. I'll take you through model A, listen for some time. My cash flows calculation will always start with year 0. So year 0, 1, 2, 3, 4, 5. 5 years of cash flows I'll have to write. Year 0, my outflow is 4,50,000. Year 1, the inflow is 1 lakh. Year 2, how much? 1,50,000. Then 2 lakhs. Last year it will not be 170, it will be 170 plus another 50,000 of salvage value. 170 plus another 50,000 of salvage value and you end up getting 2,20,000. The main objective of a capital budgeting problem is to get this cash flows. So which is almost achieved. Listen for some time. I'll take you through payback and then you do the other model. Cumulative cash flow is the cumulative value of this column. So this goes on like this. Cumulative values. Clear? The moment from negative we go to positive. Payback is achieved. Till it is negative, I get to recover my investment. The moment from negative I go to positive, my entire investment is recovered. So yet to attain payback, yet to attain payback, yet to attain payback, payback is achieved. When I go to year 4, my payback is achieved because I have become positive. The moment we become positive, we have attained the payback. Ideally, I would want a 0, 0 is not there. So now there is a formula for payback, which is base year plus unrecovered cash flow of base year divided by cash flow of next year. That's the formula. Base year plus unrecovered cash flow of base year divided by cash flow of next year. Now I'll explain the application of the formula. Payback is equal to, base year refers to the last year in which cumulative cash flow is negative. Is cumulative cash flow negative for year 0, year 1, year 2, year 3, year 4? So year 3 is my base year. Base year refers to the last year in which cumulative cash flow is negative. So 3 plus unrecovered cash flow of base year. In that year 3, how much negative it is? 20,000. So whatever is the negative for that, 20,000 divided by cash flow of next year, which is 2 lakhs. This is my payback answer. This is the payback answer. Year 3 plus unrecovered cash flow of base year divided by cash flow of next year. Divided by cash flow of next year. 3.10 years. Now, from a presentation point of view, we write it as 3 years. Can you multiply 0.10? Okay, 0.10 into 12 will be 1.2 months. The decimal part alone will be converted into months. Instead of writing 3.10 years, we write it as 3 years and 1.2 months. 3 years and 1.2 months. So the second part is multiplied with 12. That is, so what is the base year is normal years, and the second part will be multiplied with 12. Do this and then do it for the model B. Objective is always to get the cash flows. The moment cash flows are done, the problem is almost over. Model A I have done. You do model B's cash flows, cumulative cash flows, and get a payback answer. Complete model A and then do model B's calculation. 2 years, 11.3 months. That's the payback answer. The focus today's class will be to get to understand all the basics of capitalization which we have done earlier. So first mission is 3 years 1.2 months, second mission is 2 years and 11.3 months. That's as far as payback is concerned. Can I proceed to the second technique? Done with the first technique. 3 years 1.2 months, 2 years 11.3 months. Between these two, which is better? Payback, higher payback, lower payback? Lower payback. So if at all I have to make a choice, based on payback, I'll choose machine B. Clear? Any doubts in this? Next, working note 2, calculation of, or whatever working note number, calculation of ARR. Calculation of ARR, accounting rate of return. Calculation of ARR, accounting rate of return. Particulars, model A, model B. Particulars, model A, model B. Now, this is the only technique which is dependent on profits rather than cash flow. All techniques will focus only on cash flow. Accounting, the term accounting means it is profits, and so this is the only technique which is dependent on profits rather than cash flows. Now, how do we calculate this? Is average profit after tax. Average profit of, or first let me calculate total PAT. Now what is given in the question is cash flows. From cash flows, do I need to deduct depreciation to get PAT or add depreciation to get PAT? From cash flows. Deduct depreciation or add depreciation to get PAT? You have to deduct depreciation to get PAT, because PAT plus depreciation is cash flow. PAT plus depreciation is cash flow. So indirectly PAT is equal to cash flow minus depreciation. Now what is depreciation for us is, I'll take it in a simple way. Depreciation is basically, now please listen, I have net invested 4,50,000 on the project. My net investment is 4,50,000 on the project, which includes some salvage value, everything put together. Net I have invested 4,50,000 on this project. After 5 years, what is the salvage value I get? 50,000. So net in my P&L over a period of 5 years, 4 lakh will go and hit, either in the form of loss on sale of machine or in the form of depreciation. 4 lakh is going to be the hit in my P&L. Any doubts in this? My initial investment, net investment is 4,50,000. The concept is incremental, because anyway the depreciation of old machine would have been charged in the next 5 years if it was not sold. So net additionally to the P&L there is going to be a 4 lakh hit. 4 lakh hit. How 4 lakh hit? On day 1 you have paid 4,50,000. On year 5 you are getting back only 50,000. Over a period of 5 years, can you tell me what is the total of cash flows? Don't include salvage value there. Normal cash flow over a period of 5 years. How much? 8 lakhs. Now please listen. My total profit over a period of 5 years is 8 lakhs. 8 lakhs, which is what I'm getting over a period of 5 years. This doesn't include the salvage value. No? Okay, 8 lakhs minus my asset cost, which is going to be debited to P&L, is 4 lakh. Asset cost which is going to be debited to P&L is 4 lakh, either in the form of depreciation or in the form of loss on sale of machine. It could be in the form of depreciation or loss on sale of machine. So 8 lakh is the amount of profit I make over a period of 5 years, and 4 lakh, so 8 lakh is the amount of cash flow I earn over a period of 5 years, and 4 lakh could have been the depreciation which is charged. Clear? Any doubts on this? So the profit which I make is 4 lakh rupees. Profit which I make is 4 lakh rupees. Any doubts on this? In short, profit is going to be nothing but CFAT of last year. Profit is going to cumulative CFAT of last year. Profit is going to be CCF of the last year. Why CCF of the last year is, you keep ignoring, you keep eliminating the effect of initial investment here. So this 4,50,000, which is the initial investment, indirectly this will get, so on day 0 you write it as an outflow, on year 1, year 2, year 3, year 4, year 5 in your books of accounts you charge it as depreciation. That is what happens. So I invested 4,50,000, that will be charged as depreciation, and I keep getting this cash flows, which includes my salvage value also. So net cash flow which I get out of the project is 4 lakh rupees, and net profit which I am going to make out of the project is also 4 lakh rupees. Though we say depreciation is a non-cash item, technically it is not a non-cash item. The cash component of that happens on day 0. The cash component of that happens on day 0. So though in books of accounts it's like a non-cash item, but in reality on day 0 itself you spend it. So when I'm calculating my cash flows, I write from year 0. When I calculate my profit, I don't have a year 0 concept, because I cannot have a profit for a single day. So what happens is, my overall profit is nothing but CCF of last year. CCF of last year, cumulative cash flow of last year, which indirectly was 8 lakh minus 4 lakh. Any doubts on this? Any doubts on this? So now write total PAT in bracket CCF of last year. Total PAT in bracket CCF of last year. CCF of last year. Any doubts on this? Total PAT is nothing but CCF of last year. Any doubts on this? Average PAT divided by 5. Average PAT Any doubts on the average PAT number? Clear? Okay. Now please listen. Then you have listen for some time. Initial investment, ARR on initial investment. I'll explain the formula. Just listen for some time. Can you tell me what is the initial investment we have made for project A? 4,50,000. So my ARR is nothing but what I get divided by what I invest. So I get 80,000 by investing 4,50,000. So my ARR is 17.78%. Wait for some time. This is one form of calculating ARR on initial investment. What amount you invested in the beginning. Then there is something called as ARR on average investment. Now what the logic they are saying is, you said profit is 80,000 on an average, but investment on an average is not 4,50,000. Why they say on an average is not 450? Year 0 when you invest is 450. But once 1 year is passed, the value of investment is no more 450. The asset value would have come down to 380 because of depreciation. Next year again it would have come down to 3 lakh. Next year again it would have come down to 2 lakh 50. 2 lakhs. The value of the machine keeps depreciating. So they say you can also take average investment for calculation, and for simplicity purpose, average investment is, what was the initial investment? 4,50,000. Opening investment plus closing investment by 2. Opening is 4,50,000. Closing is salvage value. Closing is salvage. If there is no salvage value, closing is 0. Is there any salvage value in this question? So opening 4,50,000, closing 50,000 divided by 2. This is my average investment. On an average, the investment is not 450. On an average, the investment is only 250. And my ARR on average investment is, sorry, this is average investment. ARR on average investment is 80,000 divided by 2,50,000, which is 32%. Clear? Any doubts in this? Do this and then do it for model. 4,50,000 of initial investment, opening plus closing by 2. Which one? Correct. So on day 0 my investment is 4,50,000. So why I am not subtracting, I am explaining. So the point is, when you invest in a machinery, on day 0 your investment is 4,50,000. If I go from your books of accounts, next year what will happen is, from this some 80,000 will go off in the form of depreciation. Again another 80,000 will go off in the form of depreciation. Again 80,000 will go off in the form of depreciation. And then finally you will reach a 50,000. So mathematically, if you try to take an average of this, it may come out to be half of what I said, 4,50,000 plus 50,000, 2,50,000. So that is the logic they say add it. Can you proceed? So payback is done, discounted payback, payback is done, ARR is done. Now onwards all techniques will involve time value of money also into picture. So all other three techniques we will do it together. Next working note for calculation of discounted payback, NPV and profitability index. Discounted payback, NPV and profitability index. Okay, how do we calculate NPV? What are the columns we write for calculating NPV? We have done so many problems. Year, cash flow, PVF, DCF. What is the discount rate given in the question? PVF at 15%. I'll do it for model A, listen for some time, and then you guys can complete it for the model B. Year, cash flow, PVF and DCF. It starts with year 0. Year 0 initial outflow is 4,50,000. Then year 1 it was 1 lakh, 1 lakh 50, 1 lakh 80, 2 lakh and 2 lakh 20. These are the cash flows. These are the cash flows which we had used. Now to do NPV, 1 is the factor for year 1. 1 divided by 1.15. These are the factors which are there, and then we do DCF. The total of this is NPV. The total of this is NPV. Now for doing discounted payback, I use something called a CDCF. Like we had cumulative cash flow, this is cumulative discounted cash flow, which is first year I take this. Cumulative discounted cash flow, cumulative values of the discounted cash flows. Clear? Now below this, NPV is equal to 92,461. NPV is 92,461. Discounted payback is base year plus unrecovered discounted cash flow of base year divided by discounted cash flow. It is all payback was base year plus unrecovered cash flow of base year. Here it is discounted payback is base year plus unrecovered discounted cash flow of base year. Now which is the base year? Last year in which cumulative cash flow is negative. 4 plus unrecovered discounted, how much negative in year 4? 16,918 divided by discounted cash flow, not the normal cash flow, discounted cash flow of next year, which is 109,379. 109,379. This is my discounted payback, which is 4.15 years, or you can write it as 4 years and 1.8 months. 4 years and 1.8 months. Any doubts on this? Unrecovered discounted cash flow of base year divided by discounted cash flow of next year. And profitability index is sum of inflow by sum of outflow. Sum of inflow is this. All these are inflows. Sum of inflow is these numbers and outflow is 4,50,000. Sum of inflow by sum of outflow. The short form of profitability index is NPV plus outflow by outflow, because NPV is nothing but outflow plus the outflow minus inflow. So inflow is technically equal to, now your NPV is outflow, sorry, inflow minus outflow, that is the NPV answer. I can say inflow is equal to NPV plus outflow, NPV plus outflow. The formula for PI is inflow divided by outflow, inflow divided by outflow. It is, other name is benefit cost ratio, benefits by cost, benefit is inflow. So inflow is nothing but NPV plus outflow. Inflow can be equated to NPV plus outflow. So in short form, my formula is NPV plus outflow divided by outflow. NPV plus outflow divided by outflow, or add all inflow and divide by outflow. Both are going to give you the same answer. So I'm going to do add all inflow, sum. These are my inflows divided by, this is my outflow. 1.21 times, 1.21 times, or I could have done it as 92,461 plus 4,50,000 divided by 4,50,000. 1.21. So whatever way I do, that is fine. Clear? Any doubts in this? So I have done it for model A. You copy this and then do it for model B. Complete this and then do the same thing for the other machine. complete this. Let me know in case there's a doubt in these techniques. Can you proceed? If you're done with this, then I go to the next part. What is it? You don't have a payback. You don't have a payback. You are not able to recover the investment. So there is no payback for that. You are not able to. Negative NPV means I am not able to recover the investment. So there is no payback. So in case it is negative, your profitability index will also go less than 1 and discounted payback doesn't exist. Because by definition, payback refers to the number of years in which you recover the investment. I am not able to recover the investment, I don't have a payback. Clear? 5 techniques are done. If you are done with this, I'll go to the 6th technique. Your answer and my answer can have some differences because of rounding off and all. Done? Can we proceed? Which one? Model A's answer. Can you proceed? Anybody has any doubts in this? Can I go to the IRR part? Okay, now for doing IRR, please, everyone done with this? Listen for a minute. Okay, now can I explain IRR? Now this is what is available as of now. This is what is available as of now. We have already done one NPV calculation. In order to IRR, I need one positive and one negative NPV. Now the question started with the cost of capital, so it's easier for me to do. But a lot of questions I'll not have the cost of capital, and I don't know whether to start with 10%, 11%. If I want the exact answer of IRR is this. It's very simple to do in an Excel, and this gives me the IRR answer. 22.32% is what is going to be finally turn out to be the IRR for this project. That is what is going to turn out to be an IRR, I think. Let me just check it. I see some issues being there. I'll just explain this. Now, I don't know what rate to start with. So what we normally do is we calculate something called as ARR on average investment. ARR on average investment. So if I have done it, great. Otherwise, how quickly I close this, I put a total of all of this. This is what is going to be the total profit, 4 lakh rupees. 4 lakh rupees is going to be the total profit. So my ARR on average investment is 80,000 divided by 2,50,000. Average investment, opening plus closing. This quickly you will have to do in the calculator. You will have to quickly do this in the calculator, which anyway is already available in this question. Calculate this ARR, and my initial rate will be 2/3 of this. My first rate which I am going to use is 2/3 of this. So I will start with 21%. I will start my calculation with 21% and then increase or decrease the rate, because I may have to do this calculation multiple times. How I start with an initial rate is, you do ARR on average investment, quickly complete ARR on average investment, which we have anyway done in this question. For example, in this question, it's 32 and 17.5. 32 and 17.5. I'm going to take 2/3 of this. 2/3 of this rate and then start. Will it ensure that I get the right answer? No. It can give me a closer answer. It can ensure me that I do not have multiple iteration. Now, whenever I do an IRR question, whenever I do an IRR, what you have to always ensure is, you always need to have space for 8 columns. Whenever you do IRR, I'm going to first start with 21%. PVF at 21%, 2/3 of ARR. 2/3 of ARR. I'm going to start with 21. I've got a positive NPV. I have to increase or reduce the rate. I normally prefer increasing or reducing it by 3%, so that at least I get a positive and a negative NPV. So next is PVF at 24%. PVF at 24%. It's very easy for me to complete it because of Excel, but for you it will take a lot of time. I've got a negative. Assuming I get a positive here, I have to redo the calculation. Then that is why I say at least have space for 8 columns, so that at least you can do 3 iteration of NPV. If you have to go beyond this, then again you will have to write year cash flow and then start. Because writing year and cash flow can be avoided. So whenever you do an IRR problem, have space for 8 columns, open 4 columns. You get a, anyway 6 is minimum required, because 1 positive and 1 negative is required. So I've got a positive at 21%, negative at 24%. I'm going to get an IRR with the help of this. 2/3 of ARR is what I start with. 2/3 of ARR is what my starting point is. It is not necessary that in 2/3 I get a number closer to this. Now what I finally get is NPV at 21% is 14,823. NPV at 24% minus 17.754. I have a formula, I'll give the formula in some time. Difference in NPV. Between these two, the difference in NPV is 32,570. From positive, we are going to negative. Difference in rates 3%. 3% change in rate lead to 32,577 change in NPV. A 3% change in rate lead to 32,577 change in NPV. Now what we are trying to do is 21, 24, 21 is 14,823. This is minus 17,754. So there is a difference which exists between 21. I have to somewhere get 0 NPV. So 3% change in rate lead to 32,577 change in NPV. What percentage change in rate will lead to only 14,823 change in NPV? Will lead to only 14,823 because from 14,823 I want to reach only 0. So it's basically 3 equal to 32,577 question mark equal to 14,823. 3 equal to 32,577 question mark equal to 14,823. Cross multiplication, tell me what is question mark. If 3 is equal to how much? 1.36. Clear? Any doubts on this? How 1.36 would have come is 14,823 divided by 32,577 into 3. Cross multiplication and you get to this number which is 1.37. I am getting it as 1.37 and my IRR is equal to 21 plus 1.37. This is my IRR, 22.37%. Now the formula for this IRR is L1, it will be L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. Technically an interpolation formula. If you remember the formula, great. L1 means lower rate. So in this case 21 plus NPV at L1 is 14,823 divided by 14,823 minus of minus 17,754 into 24 minus 21 into 24 minus 21. You want to do it in graph way or timeline way or the formula way, it's up to you. But this is the approach. I will have to start with ARR on average investment quickly in the calculator, get 2/3 of that, that is my first rate, and then increase and decrease the rate. Increase or decrease, do it by 3% to get quickly one positive one negative. So the answer which we have got is 22.37. The exact answer is 22.32. Why this difference comes is I took a change of 3%. Instead of taking a change of 3%, if I take 2 or if I take 1, the lower the difference between L1 and L2, more accurate will be our answer. So in this case, I need not worry about 22.37 is what we have got. We'll proceed with that. Now, ARR you know how to calculate. So that is just an approximate. They say you take 2/3. 2/3 is 32 into 2 by 3. No logic. No logic. So it worked here. So this concept will work in 90% of the problem. So whenever I do a problem on IRR, the issue which anybody will face is what rate to start with. So to start with what rate, because otherwise you will start with 10, you will see a huge positive, then you will do 15, then you will do 20, then you will do 25, one positive, one negative, then only that's a guess rate. So it's not necessary. So some problem what will happen is below the question they will say 18%, 20%, 24%, 26. I know my answer is somewhere in between. I start with 18. I need not even do this 2/3 concept there. So below the question, if they give me some rates, I know my answer is going to be there. I start with those rates. So in a practical world, when I look at a cash flow, if you get a lot of experience in capital budgeting, looking at the cash flow, you will say that your answer is going to be closer to 10, closer to 20, closer to 25. But at this point of time, it will be very difficult for you to understand what is going to be final IRR. In Excel, I can quickly do and complete it. So from an exam point of view, how do we proceed is do a ARR calculation. Even if you go wrong in ARR, it doesn't matter. Even you go wrong in two-third also, it doesn't matter. The only problem you will have is you may have to do it multiple times. The two-third concept will work in most of the problems, but at times it doesn't work also. So you will have to keep increasing, reducing the rate. At 21 we got positive NPV, at 24 we have got negative NPV. Complete this, then I take you through the next model. Any doubts on this? Can you go to the next mission? Model B. Next model. You're done with model A, no? Model B, can we start? So start with it. 2/3 do. What is the 2/3 rate? 11%. What is the rate? Okay, so try at 11. Mostly you'll get a, because 15 itself is positive. So let's do it that way itself. 2/3 rule. Have space for 8 columns. Do at 11. See if this, I'm just explaining the 2/3 rule because I know 11 is of no use because 15 itself is positive. So ideally my start is 15 and then I increase the rate. So though that's why I said 2/3 rule may not work always. In this model B it's not going to work out. 15 is already done. 11 is of anyway no use. So after 11 you do some 18 or 19%. 15 already we have the answer. So you do 18% maybe. 11 is going to be of no use. Still we have done it. After 11 do 18 or 19. Fifteen answer is already available, so maybe do an 18%. IRR as per our computation is 16.47%. The exact one is 16.43%. Our calculation is 16.47%. So in this problem, the 2/3 rule didn't work out. It's not necessary that 2/3 rule has to work out. Sometimes it works, sometimes it doesn't work. You will understand this more in the second problem, which I'm going to do now. When I do the second problem, you will understand that better. Any doubts on this? So we have revised all the 6 techniques, or kind of we have done all the 6 techniques. Technique 1 is payback, which is base year plus unrecovered cash flow of base year divided by cash flow of next year. Discounted payback is base year plus unrecovered discounted cash flow of base year divided by discounted cash flow of next year. Npv inflow minus outflow, profitability index inflow divided by outflow, and IRR is 1 positive, 1 negative, and you finally get the answer. And ARR is PAT divided by average investment or initial investment. Clear? Any doubts on this? Any doubts on this? Clear? Now please listen. In case I have to do, which may not be necessary at your level, they may not ask, but if I have to do all the 6 techniques together, I'm not going to separately do a working note. My working note will be year, cash flow, cumulative cash flow. This will help me in payback. PVF, DCF. This is going to help me in discounted payback, NPV, profitability index, and to kind of IRR also. Depreciation, PAT. This will help me in ARR. So I'm going to do it together. I'm not going to do separately, do every working note. So which one? Okay, sorry, CDCF. Sorry, yeah, CDCF. So I'm not going to separately. So these 8 columns is what I will use to calculate all the techniques together. Year, cash flow, cumulative cash flow, PVF, DCF, CDCF, depreciation, PAT. IRR, maybe you have to do a little bit of more calculation or open 2 more columns, which space may not be there. But IRR, maybe you have to repeat it little again. But this will help in getting me the answer to all the 5 techniques. Year, cash flow, cumulative cash flow, payback. PVF, DCF, CDCF, discounted payback, NPV and profitability index, depreciation and PAT is for ARR. Even depreciation PAT is not required. Even if you remove it, it's fine. ARR is anyway easier to do. Clear? Any doubts on this? So we are going to do all the techniques separately and end up spending so much of time. So this problem took us some 1.5 hours. In an exam also, if you do it separately, you may end up spending 30 minutes. So you will club it and do it together. Clear? Can we proceed? Any doubts on this? I think this format is covered. Yeah, the format is here. Consolidated format for calculation of all techniques. Year, cash flow, cumulative cash flow, PVF, DCF, CDCF, depreciation and PAT. There is an example, you can do this at home. Fill this table at home to get the answer for all the techniques. Now I'll focus more on the IRR part. The second problem will focus on IRR. Let's do question 1. Cash outflow of 20,000 in year 0 and 2 years later of 25,992. Okay, now there is one outflow, one inflow, which is easy to do now, right? Present value equal to future value into present value equal to future value into 1 divided by 1 plus r the whole power n. Present value equal to future value into 1 divided by 1 plus r the whole power n. From future, if you want to go to present, it is division. If you want to go from present to future, it's multiplication. So I can do it anyway. Present value equal to future value into 1 divided by 1 plus r the whole power n. 20,000 equal to today's value, present value 20,000 is equal to 25,992, 20,000 equal to 25,992 into 1 divided by 1 plus r the whole power 2. 1 plus r the whole power 2. You solve this and you'll get R, that R is IRR. R is basically the rate of return. 20,000 equal to 25,992 yeah, so that's the answer. Whatever you get, 20,000 equal to 25,992 into 1 divided by 1 plus R the whole power 2. IRR is nothing but that R which we use. So when we calculate present value, future value, wherever that R is getting used, that's basically the IRR. Can we proceed? Now second part, IRR of a project with outflow of 50,000 and inflow of 8750. What is the formula for perpetuity? Perpetuity is equal to what? Present value of perpetuity equal to perpetuity amount divided by time value of money. That divided by time value of money is IRR. Present value is 50,000. So 50,000 equal to 8750 by IRR. Present value of perpetuity equal to perpetuity amount divided by time value of money in bracket IRR. The TVM is IRR. Time value of money, that is basically IRR. How much? 17.5%. Can we proceed? Any doubts? Now the third one says outlay of 50,000 and annuity inflow of 15,500. Can I proceed to see? Outlay is 50,000, inflow is 15,500 for a period of 4 years. For this information, I want you to do ARR on average investment in the calculator. Every year you are going to receive 15,500. First year 15,500, second year 15,500, third year 15,500, fourth year 15,500. ARR on average investment in the calculator. No, it is not 15,500 by 50,000. Please listen. 15,500 is your inflow. So for the 4 years in the calculator, do 15,500 into 4 minus 50,000. This is the profits for a period of 4 years. Why I subtract 50,000 is that's the depreciation for a period of 4 years. Divide this by 4. How much is this? This is average PAT. Wait. This is average PAT. Average investment is 25,000. Half of 50,000. 50,000 plus 0 by 2. 50,000 plus 0 by 2. How much? 12,000. 3,000. So 12%. Okay, 12% is the number. Now my first rate is going to be 2/3 of 12%. So this calculation we'll have to do in calculator. Again I'll explain. 15,500 into 4, because it's the 4 year the same amount, minus 50,000 is the average total PAT for a period of 4 years. Total PAT for a period of 4 years is 15,500 into 4. 15,500 into 4 minus 50,000. This divide by 4 is the average PAT, which is 3,000, Average investment is 25,000 and ARR is 12%. None of this will come in your notebook. You're not going to write any of this. This has to be done in the calculator. What is 2/3 of that? So let's start Npv calculation at 8%. That is where that role is. The role of that is to know which rate to start with. Year cash flow PVF at 8%, DCF. Now listen for a minute. 0, 1 to 4. I'm going to do it together because it's an annuity. Year 0 I spend 50,000. 15,500 is what I receive every year. In the calculator, 1 divided by 1.08. 1 divided by 1.08 equal to M plus. This is first year factor. Equal to M plus, equal to M plus, equal to M plus, and MRC will give me the 4-year factor. 1 divided by 1.08 equal to M plus, equal to M plus, equal to M plus, equal to M plus MRC. What is that number MRC? 3.4 digit, 3.3121. Okay, 3.3121 is basically the factor. You get a positive or negative, you increase or reduce the rate accordingly. So then reduce the rate to maybe 6%. Why 3 not 5%? Looking at the answer, you can understand whether it is going to be 6% or a 5%. You can even do 5%, doesn't matter. From 8 I have to increase the rate. You'll have to increase the rate to 10%. Increase the rate to 10%. Positive. Positive means you will increase the rate. Negative means you will reduce the rate. So increase the rate to 10%. 1 divided by 1.08 equal to M plus, equal to M plus MRC. We have got a positive NPV. Increase the rate. How much? Positive, negative. Then you can get the answer. One positive, one negative NPV is needed. Any doubts on this? Any doubts on this? Can I proceed? For the next one, can you quickly tell me what is ARR on average investment? ARR on average investment for the next cash flow. $18. 450 plus 425 plus 400, it adds up to 1225. 1275, 275 is the PAT. So average PAT is 90. How much? Some 18 point some number will come. Okay. Your ARR is 450 plus 425 plus 400 minus 1000. That's the overall profit. Divide that by 3. The overall profit divided by 3. That is some 90 rupees something will be there. Divided by 500. Average investment is 1000 plus 0 by 2. So how much is that answer? 18. 18 no? Start with an initial rate of 12%. Start with an initial rate of 12%. 2/3 of ARR. So 18% is the ARR. Start with 2/3 of that. Have space for 8 columns at least. Do a 12%. Start at 12%, 2/3 of ARR. The rule is that the trickiest part will be is to start with what rate. So for doing that, you do 2/3 of ARR. The final answer is going to be closer to 2/3 of ARR. Can you proceed? Any doubts on this? Can I proceed to question 3? Any doubts? Any doubts till now? Any doubts? So IRR, the simple rule is take 2/3 of it and then try to do the calculation. You will end up getting the answer. Because the issue which most of us face in IRR is what rate to start with. You don't want to do this 2/3, then start randomly with 10%. That's also fine. But that time you have to see based on answer whether you have to increase it very high or reduce it. So that issue will crop up. Otherwise, do 2/3 of ARR. Mostly we'll get a closer answer. Can we proceed? Now let's go to question number 3. Please go through this question. Cost of? Cost of capital is the percentage, no? 10%, 12%, 14%. Your cost of capital, first problem we did know, cost of capital was required rate of return is 15%. That's called a cost of capital. Project is what is your outflow? Okay. Now coming to this question, they have given annual cost saving, useful life, IRR, profitability index. Cost of capital is basically the discount rate is required to be calculated. Cost of project is missing in the question, which is outflow. Payback, number of years it takes to recover the money, and NPV is missing. Now tell me, how do we proceed with this question? I've explained all the 6 techniques and you have already learnt at IPCC level. Now what will be the starting point? If you are able to solve this question, it will give you a grip on all the 6 techniques. Okay, so with that, no, you need not bring profitability index as of now. You said what you said was right, but why are you bringing profitability index? At IRR, NPV is 0. NPV plus outflow. Where is the outflow first? No, so NPV plus outflow by outflow. You don't know NPV? No, but then I cannot assume the NPV to be 0, no? That is going wrong, no? So for example, when we did question number 1, the IRR answer for the question was, for example, the NPV answer for this question was 90 to 461. At IRR, NPV is obviously going to be 0. So can I conclude saying that NPV is 0? And if you conclude that way, 0 plus outflow by outflow will be 1. You say NPV is 0, no? 0 plus outflow divided by outflow is going to be 1 only, no? How will you get a different answer? You went in the right direction, but something else to be done. I cannot take NPV to be 0. Then the problem is over. You will say NPV to be 0, then profitability index has to be 1, no? You went in the right direction, tell me what else I can do. Okay. What is the cost of capital? I don't know. So how do we proceed? Now, if you look at this question, for example, listen for some time. When I did my IRR calculation, we did 12% calculation here, we did 14% calculation, I can also do a 13.51% calculation. When I do a 13.51% calculation, my NPV is going to be 0. Yes. Now listen for some time. Present value of inflow, present value of outflow. At 12%, the present value of inflow is this number, 1025. Present value of outflow was 1000. At 14%, the inflow is 995 and 1000. As you change the rate, your present value of inflow will keep changing, but present value of outflow will never change. So at IRR, my present value of inflow is going to be equal to present value of outflow, and with that, what I am going to calculate is the initial project cost. Because my outflow be it 12%, 14%, 16%, 18%, any rate you use, your present value of outflow is going to be the same. So at IRR, the NPV is 0. That will help me in calculating the outflow. I cannot calculate NPV to be 0. So working note 1, calculation of cost of project. Calculation of cost of project. Calculation of cost of project. Below that, right? IRR is the rate of return. IRR is the rate of return. Is the rate of return at which NPV of the project is 0. IRR is the rate of return at which NPV of the project is 0. 4 columns: year, cash flow, PVF at, what is the IRR rate? PVF at 15% and DCF 0, 1 to 4. My initial investment is X rupees. My initial outflow is X rupees. Every year I get 40,000. Every year I get 40,000. Can you tell me the annuity factor for 15% for 4 years? How much? Okay, 2.855. This is going to be 1. This is X. X plus 114,200 is 0. X plus 114,200 is 0. X plus 114,200 is 0. What is the cost of the project? 114,200. Any doubts on this? This does not mean NPV of the project is 0. Please understand, NPV of the project is not 0. IRR is the rate of return at which NPV is 0. So based on that, I've got the cost of the project 114,200. Now tell me, how do you want me to proceed? How do you calculate? Okay. So profitability index is in short inflow by outflow. Outflow is 114,200. You will get the inflow. NPV is inflow minus outflow. Clear? Any doubts on this? Next, working note 2, calculation of NPV. Calculation of NPV. Calculation of NPV. PI equal to profitability index equal to inflow divided by outflow. Inflow divided by outflow. Profitability index equal to inflow divided by outflow. inflow divided by outflow. PI is how much? 1.064 is equal to inflow divided by 114,200. Inflow divided by 114,200. Then inflow is equal to 114,200 into 1.064 and NPV is Can you proceed? What other thing is asked in the question? Cost of capital I'll come to in some time. Payback, can you do year, cash flow, PVF, DCF and calculate payback? It's payback, not discounted payback. So normal payback. Year, cash flow, PVF. Sorry, year, cash flow, cumulative cash flow. Year, cash flow and cumulative cash flow. Get the payback answer. 2.855 years will be the answer. Plus 2.855 years. Any doubts in this? Clear? Can you proceed? Now cost of capital is asked. I'll tell you how it is to be done. In this question, below the question there has to be a table which was there. I have removed that table. If I have that table only, I'll be in a position to answer cost of capital. So I need that table. So I don't have the table, but I'll explain the concept and then I'll tell you what is there in the table. Now, what we did here was with the help of IRR. Now I don't know the rate, so this is what we are required to calculate. PVF at what rate we don't know. This we have identified now, 114,200. So this number is 114,200. I don't know this now. I also don't know this because PVF at what rate we don't know. So is it 10%, 12%, 15%, 20%? That rate is required, which is missing in the question. But year and cash flow is like this. NPV is not 0. NPV is how much? 730. Okay, 09, 7309. This can be 7309 if my inflows are 121,509. This is the base structure. My inflows can be 121,509 if this is 3.038. If this is 3.038, that is 4-year annuity factor has to be 3.03. Below there is a table which will give, in this question it's not there, so below the question there was a table which will tell for what rate is the annuity factor 3.038, which is going to be 12%. That information is missing in the question. I should have ideally put that table. So there will be a table which will show, just a minute. Table? No, they will have to give the table for annuity purpose. For annuity purpose, they'll have to give it. For normal purpose, they need not. Just a minute. This is how the question was. Below this is what would have been given. 15%, 14%, 13% and 12%. Now basically what you need to do is to get the annuity factor, you'll have to add this. So the total of this will be one number, the total of this will be there, the total of this will be there, the total of this will be there. One of the total will match with 3.038. This table is missing in the question. In exam, this was there. So this is IPCC problem, not final problem. So there this table total was there. So if you look at the total for 12%, the total will be 3.038. Clear? So based on that, we will say that 3.038 corresponds to 12% and hence cost of capital is 12%. Clear? Able to understand this? Can you just do a total? Does it add up to 12? Just a minute. Just add this 12% guys. Okay. So from that table, we finally conclude saying that IRR is, cost of capital is 12%. Clear? For this, they have to give this table. Otherwise, it's very difficult for me to proceed. Clear? Now, do this calculation of cost of capital. Calculation of cost of capital. You can write from the PVF tables, PVF of 3.038. From the PVF tables, PVF of 3.038 correspond to 12% and 4 years. From the PVF tables, PVF of 3.038 3.038 correspond to 12% and 4 years. Full stop. Hence cost of capital is 12%. Cost of capital is 12%. Go through question 4. Okay, the project cash flows are available. We need to calculate the NPV. Then there is second part, which is step up discount rate. So first let's do the normal NPV. Working note 1, calculation of NPV. Calculation of NPV. Calculation of NPV. 4 columns. Year cash flow PVF DCF. Year cash flow PVF DCF. Year cash flow PVF DCF. Zero, 1, 2, 3, 4, 5. Write the cash flows as it is. Zero, 1, 2, 3, 4, 5. What is the initial outflow? 10 lakhs. The cash flows are given in the question. I am doing this problem to explain part 2 of the question. So write 10 lakhs. We are solving this question for part 2, 10 lakhs. Then year 1, 1,20,000. Year 2, 3 lakhs. It's not 2 lakhs. 2 lakhs is the cash flow. Salvage value is 1 lakh. Dismantling is 3 lakh. Net you get a 0. Net you will get a 0. 2 lakh is the cash flow. Dismantling cost of the asset is 3 lakh rupees and salvage value is 1 lakh. So net what you get out of it is 0. Normally cost of dismantling will not be higher than the salvage value, but the question has given. Let's proceed with whatever it is. Any doubts in this? Now the second part says the discount rate is what? 12% and it increases by 2% every year, which is called a step up discount rate. We have done this when I did bond valuation also. The discount rate need not be same for every year. Now please listen. First year it is 12%. When you do second year, it is the first year factor divided by 14%. You cannot do divide by 14 divide by 14. See, now please listen. This is one way of calculating. The other way of calculating is 1 divided by 1.14 divided by 1.14, 2 times 14%. This factor and this factor has a difference. That is why what you do in case of a step up discount rate is take the first factor, second factor you will divide by 14%, first factor divided by second factor, third when you do divide by 16%, fourth when you do divided by 18%, and fifth when you do divided by 20%. It is not 1 divided by 1.20, 1.20, it doesn't go like that. First year factor divided by 1.14, 1.14 is the second year factor. Second year factor divided by 1.16 is the third year. It goes on like that. Now please listen. It's covered in the theory part here. Listen for it. Listen for some time. I'll complete this theory part of discount rate. Discount rate refers to the rate of return which providers of money expect. The appropriate discount rate is cost of capital. The reward discount rate can be uniform or this can be a step up increase. PVF for year 2 will be PVF of year 1 divided by new 1 plus R, and PVF for year 3 will be PVF of year 2 divided by new 1 plus R. It is covered in page 9. Go to page 9 and fill this PVF. Go to page 9 and fill this PVF. If you are filling the PVF correctly, you have understood it. 9, page 9. Fill the PVF which is there. Fill the PVF in page 9. Step up discount rate. First one will be 0.909, 1 divided by 1.10. For the second year, it will be 0.909 divided by 1.08. 0.909 divided by 1.08. Some people in a hurry end up doing 1 divided by 1.08 divided by 1.08. So don't do that. Take the PVF of year 1 and divide by 1.02. PVF of year 2 and divide by 1.11. PVF of year 3 and divide by 1.13. You can then calculate this Npv. Yep, there's zero cash flow. Should the project be accepted is one part, and the next part is without dismantling. Totally 3 questions are there. The first one is original scenario, second is step up discount rate, third is step up discount rate without dismantling cost. What if there is no dismantling cost at the end of the project? then you will have to rework assuming there is no dismantling cost. Any doubts on step up discount rate? Again, you'll have to recalculate assuming there is no dismantling cost. So the cash flows will undergo a little bit of a change. Any doubts on this? One lakh. Why it has to be reduced? 2 lakh plus 1 lakh. 2 lakh is normal cash flow. Salvage value is 1 lakh. 3 lakh. We used to do 3 minus 3 is 0. 2 plus 1 minus 3 was the 0. If there is no dismantling cost, the last year will be 3 lakhs. See, the third part is it's just a formality. There's nothing much to learn there. What you learn in part 1, even the learning is only in part 2. Step up discount rate. What we do if it's a step up discount rate. So the learning is more in part 2 of the question. Your discount rates is not at, is initially at 12%, then at 14, then at 16, then at 18, then at 20. That's where the learning is there. Clear? Can we proceed? Any doubts? Can we? Go through question 5. Go through question 5. Tomorrow our class will be from 6 to 6. In case you are not able to attend it, I'm trying to record the video in the laptop. So in case it gets recorded properly, I'll send the link to you guys so that you can refer it in case you're not able to attend it. Only for the capital budgeting part, I'm recording it so that I'll just share it with you guys. Now coming to this question, They've asked NPV of the project, and the second part of the project is maximum volume of sales per annum required to justify the project. What is the initial outflow of the project? Read it carefully. 48 or 40? So I'm asking, is it 40 or 48? Okay, it's not 48, it is 40. This problem, you're going to use a rule called as rules of relevance, which is not something which you are learning in SFM. You learn that in costing. Relevant costing rules, which says that the decision which I'm going to take now is whether to invest in a project or not. Whether to invest in a project or not. ABC Limited is considering whether to invest in a project or not. If you go ahead with the project, you will spend 40,000 on the machine. If you don't go ahead with the project, you will spend 0 on the machine. It's a relevant cost. Feasibility study, if you do the project, you have spent 8,000. If you don't do the project also, you have spent 8,000. So feasibility study is an irrelevant cost. It is an irrelevant cost because it is not, though it is linked to the decision I am making now, but from a relevance point of view, it is of no use. Assume the question says the company has already purchased the machine. Then from a relevance point of view, if you do the project, you have 0 outflow. If you don't do the project, you can sell the machine for 10,000. Then the initial outflow is only 10,000, not even 40,000. Not even 40,000, it's only 10,000 if you have already purchased the machine. So if I have purchased the machine and now I am thinking whether to do the project or not, if you do the project, outflow 0, inflow 0. If you don't do the project, machine will be sold for 20,000. Then from a relevant point of view, your initial outflow is 20,000 because you lose the opportunity of selling the machine. You lose the opportunity of selling the machine. So relevant costing you would learn there, but important part is whether to find something as relevant or not. If I do, what happens? If I don't do, what happens? For example, I want to do the project in my own factory, which is owned by me. So I have my own building which is available. So I use my own building for the purpose of project. Will I pay any rental for it? My own building. No rental for own building. But if I do the project, rent expense is 0, rent income is 0. If I don't do the project, I let it out for 50,000. I let it out for 50,000. So rent income could have been 50,000. So from a relevant costing point of view, the rent expense will be taken as 50,000 rupees. You will take the rent expenses 50,000. Whether you are paying or you are not paying, I am not bothered about it. The point is it relevant or irrelevant? So if it's my own factory, I don't pay any rent. But what are we going to do with the factory? I could have let it out for 50,000. Then this project should at least give me 50,000. So in the project, there will be an opportunity cost called as 50,000. So to decide whether it is relevant or irrelevant, it's only one check. If you do, what happens? If you don't do, what happens? If you do, this will happen. If I don't do, this will happen. If there is a difference, it is relevant. If there is no difference between both the parts, then it is irrelevant. Clear? Any doubts in this? Any doubts in this? So that's the logic we have to do. Working note 1, initial outflow. Working note 1, initial outflow. Working note 1, initial outflow. Initial outflow. Particulars and amount. Capital expenditure. How much is the capital expenditure on the machine? Minus 40,000. Then feasibility study 0. You can write an explanation, or in feasibility study in bracket you can write sunk cost. This is technically called as sunk cost. Cost which has already been incurred. Now please listen. When can a feasibility study become relevant also? If I am yet to do a feasibility study. If I am yet to do a feasibility study, then it is relevant. Listen for a minute. I put a condition to the person who does a feasibility study. I tell him that you will give me the report. If I end up doing the project, I'll pay you 20,000 for the report. But if I'm not doing the project, I'll pay you only 10,000. That's kind of an agreement I enter with him. So you do the feasibility study. If I do the project, I'll pay 15,000. If I don't do the project, I'll pay you 10,000. That's the agreement I enter into. 15,000 if I do the project, and if I don't do the project, I'll pay 10,000. Can you tell me how much is relevant now? If you do the project, 15,000 you have to pay. If you don't do the project, you have to pay 10,000. He has already given me the report. Is there anything relevant? $15,000 I have to pay if I do the project. 10,000 you have already done your work and you have given me a report. I see the report. I say I'm doing. I'll pay you 15. I say I'm not doing. I'll pay you 10. You also were okay with this. 5,000 only is relevant. Balance anything is. So if see how I do is yes, no, S 15,000, no 10,000. Relevant is S minus 1. Today yes 8,000, no 8,000. 8,000 minus 8,000 0 is relevant. Project capital expenditure yes 40,000, no 0. Relevant is 40,000. S minus 2. To find out relevant, S minus no. Yes means what will happen, no means what will happen, and the difference is relevant always. Clear? No, to find out whether it is relevant or not. So the point is payment for feasibility study is not contingent upon whether I take up the project or not. Whereas purchase of machine is contingent upon whether I take up the project or not. If I take up the project, I will pay for the machine. If I don't take up the project, I am not going to buy the machine. So purchase of machine is linked to the project. Feasibility study is not linked to whether I take up the project or not. But it is linked to the project, but it's not linked whether I take up the project or not. So irrespective of your decision, your feasibility study payment has to be done. So that is why it is irrelevant. So lot of times, see relevant costing you will learn it in AMA, but lot of times if you do this yes or no analysis, you will understand. For example, if I buy a movie ticket, the relevant cost of buying the movie ticket is 200 rupees. The moment I have bought the ticket, if somebody says, if I am not able to go for a movie, I decide that I will not be in a position to go for a movie. Before buying, the worth of the movie ticket is 200. After buying, the worth of the movie ticket is 0. The moment you have purchased it, because you cannot cancel it. So somebody says, I'm okay to pay you 150 rupees for the movie ticket, I should go ahead and sell it if I am not in a position to go for the movie. If not, because the real worth for us, the moment the movie ticket is purchased is 0. Because if you end up not going for the movie, what will happen is you are not going to get any benefit out of it. So the point is always that before I buy the machine, the worth of the machine is 40,000. Before I buy a mobile phone, the worth of the mobile phone is 10,000. The moment you open the seal, the worth of the mobile phone becomes 5,000. Why it becomes 5,000? Because if you have to sell, you'll be in a position to sell it only for 5,000. That's what relevant costing says. You will have to consider what is relevant. So the worth of the mobile phone, which was 10,000, the moment I open it becomes 5,000. Because that's how electronics industry works. Or it becomes 8,000, 7,000, whatever it is. But the worth of the phone obviously comes down. The moment you can even tell the other person saying that I just opened it, he will not agree to get it at 10,000. You try selling your mobile phone, after opening the seal, nobody will get it at 10,000 at least unless you are able to explain to your vendor and give him back. To any other person you want to sell the mobile phone, you will not be in a position to sell it at 10,000. Saying that I have not even utilized it, he says nothing doing. Because if I have to pay 10,000, I'll pay to the company itself and buy it at 10,000. So that is what it is. So if this machinery was already purchased by the company, I wouldn't have even written 40,000, I would have written only 20,000 or 25,000, depending on what is the realizable value of the machine. So feasibility study, if it's already done, can I tell the other person that I'm not doing the project, I'll not pay you for the feasibility study? No. If you have put in your effort, so as a consultant, if I have put in my effort, you give me 8,000. Irrespective of whether you want to do the project, not do the project, I'm not bothered about it. So that's the concept. Clear? So initial outflow. Initial outflow is 40,000. Initial outflow 40,000. practically all the decisions should ideally be taken on the basis of relevant costing, but a lot of times emotions play a part in our decision. So as such, for example, if I've already purchased a movie ticket for 200 rupees and somebody asks for 100 rupees, I may not want to sell it. I may allow it to even go waste. I may allow it even to go waste, but I'll not sell it at 100 rupees. That is emotions playing a part rather than going by the concept of relevant costing. Working note 2, calculation of in-between flows. Calculation of in-between flows, particulars and amount. Okay, now I'll introduce you to the format of in-between flows also. In-between flows will start with revenues. Let me take you through the format. This is the format we are going to use. Revenues, I deduct all costs other than depreciation. I get PBDT. I separately do a depreciation deduction. We get PBT, less tax, PAT, add back depreciation and CFAT. You understand till that. Other parts not required as of now. I'll explain later. Now, this is also kind of a flexible format. When I say flexible, certain problems you will start with sales. Some problem you will start only with PBDT because the information given in the question is only PBDT. Some problem you may start even with PBT. Some problem with PAT, some problem CFAT could be directly given. So there are 5 things which are there. The format can start with sales. The format can start with PBDT. If I have to start with sales, I need to know what is unit sold and what is the selling price. If that is not there, I'll start with PBDT. If that is not there, I'll start with PBT, I'll start with PAT, or I'll start with CFAT. Now, this depreciation adjustment, why are we doing? I'm deducting depreciation, adding back depreciation. Why should I do this? For the purpose of tax calculation. Assume a problem does not have tax information, I'll not even deduct depreciation. Because tax is not there, why should I deduct depreciation? So, if a problem does not have tax data, the PBDT which you see now will become CFAT. Why? Because I don't want to deduct depreciation. There is no tax obviously in the question, and I don't want to add back depreciation. So if taxes are not there, PBDT will play the role of CFAT. PBDT will play the role of CFAT. If taxes are there, you end up doing this. In this question, can we calculate sales? Do we have adequate information to calculate sales? Do we have the unit sold data, selling price data? Yes. Can you quickly tell me what will be the unit sold? Probabilities are there. What should be the unit sold figure? Using those probability, what should be the unit sold figure? $7,000. It's 0.10 into 2000 plus 0.25 into 6000 plus 0.40 into 8000 weighted average. Wherever probabilities are there, so the sales volume is this, expected sales volume is weighted average of the probability. What number you get? 7,800. Okay, right. Units sold 7,800. Units sold 7,800. Selling price, selling price is 10. Any doubts on 7,800 number? Weighted average, selling price is 10, sales. Sales is 78,000. Less variable cost. How much? 7,800 into 6. Sales 7,800 into 10. Variable cost is 7,800 into 6. Now there are those three fixed costs. I'll have to decide whether they are relevant or irrelevant. Rent, what do you think? You do a yes or no analysis and then let me know. Rent is relevant or irrelevant? Rent? Relevant, because I'll incur only if I'm producing this product, otherwise I'm not going to incur this. See, as a general rule, all fixed costs are irrelevant unless provided otherwise. All variable costs are relevant unless provided otherwise. That's the rule of costing. All variable costs are relevant unless provided otherwise. All fixed costs are irrelevant unless provided otherwise. So rent, if you do the project, pay 10,000. If you don't do the project, pay 0. If you do the project, pay 10,000, because rent says annual rental would be payable only as long as the new product is manufactured. If you are not manufacturing, you are not going to pay rent. So less rent, how much? 10,000. Then think about the second one, head office apportion expense. Head office apportion expenses like this. Branch is in Chennai, our head office is in Bombay. So they incur expense in Bombay and then say Chennai branch will have so much expense, Mumbai branch will have so much expense, Bangalore branch will have so much expense, Hyderabad branch will have so much expense. Assume I close down Chennai branch. What they are going to do, the same expense they'll split now to Hyderabad and Bangalore. So as such, what I incur there is going to be same. It's just going to be distributed to the various projects. So head office apportion expense, if you do the project, they'll apportion to my project. If I don't do the project, they'll apportion to Bangalore or Mumbai or somewhere they have to apportion it. So head office apportion expense is irrelevant. So less head office apportion expense, 0. Less head office apportion expense, 0. What about other expenses? Nothing is given in the question. Your assumption you can take, but generally all fixed costs are irrelevant. So other expense in bracket assumed to be irrelevant. Less other expenses, assumed to be irrelevant. You can take it as relevant also if you want to. Write the assumption and then go it. This will give me PBDT. PBDT. PBDT figure is 21,200, deduct depreciation. Depreciation, how much is the depreciation? Is there a tax rate in the question? Okay, there's no tax rate, then no tax rate. Okay, PBDT slash CFAT, that's all, leave it. I need not calculate depreciation if tax rates and all is not there. PBDT slash CFAT. PBDT slash CFAT. If tax is not there, we are assuming taxes are complete this and then do terminal flow. PBDT figure has been taken as CF80 because there is no tax given in the question and assuming taxes are ignored. Next, working note 3, terminal flow. Working note 3, terminal flow. Terminal flow. Terminal flow. Particulars and amount. Terminal is you will sell the machine and get some money out of it. So there will be a sale of machine and we'll get some money out of it. Salvage value. How much? 3,000. 3,000 no salvage value. The project after which would be sold as scrap which would fetch 3,000. There's something called as net salvage value. I'll explain all of that in the next class when I bring taxation into impact. As of now, taxation has not been brought. Salvage value 3,000. Clear? Any doubts till now? Now I'll take you through the NPV calculation. So the objective is to calculate the cash flow in 3 steps. Working note 1 initial, working note 2 in between, working note 3 terminal, and working note 4 is consolidate the cash flow and calculate NPV. So year cash flow PVF. What rate is the PVF in this question? 10% and DCF. Now year 0, my initial investment will come from step 1. I'll go to step 1 and find out what is the initial investment, which is 40,000. Year 1 to 6. In this question I am clubbing because I am going to receive an annuity, which is, and year 6 additionally. Now for this 1 to 6 you will use the annuity number and year 6 you will use the normal number and get me the NPV, calculate NPV. Working note 4, consolidation of cash flow and calculation of NPV. Consolidation of cash flows and calculation of NPV. When you calculate the annuity factor for the 6th year after putting M plus, before putting MRC, note that factor that will be required for year 6. Before doing an MRC, note the factor of year 6 that will be required for year 6 number. One divided by 1.1 equal to m plus equal to m plus, you keep doing that. Before putting an MRC, note the 6th year factor that will be required for year 6. I'll just complete this. Another 5 minutes if you can spend, the problem will be over. Okay, I'll just explain the second part. What you need to do, you can maybe even try it at home. Minimum volume of sales per annum required to justify the project. So minimum volume of sales per annum required to justify the project is, when will you take up a project? So what is technically break-even point? So your costing says fixed cost by contribution. That's not what we use here. Here what I'll use is if NPV is 0. So this calculation which I have done, I don't know the sales volume. So I need an NPV of 0. I need an NPV of 0. This number I am leaving it blank for the time being. So my initial outflow is 40,000. This is 1693. So this number has to be this number has to be 38307. This number has to be 38307, and this number can be 38307 if this is 8796, and this can be 8796 if some units are sold. So you will have to repeat this calculation here. I need a 8796 here. I need a 8796. So sorry, listen for some time. Profit is 8796. This is what I need. CFAT. I need a CFAT of 8796. Fixed cost is 10,000. Contribution which you need is 18,796. Contribution per unit is 4 rupees, and units to be sold is, if I sell 4,700 units, that's more than enough for me. 4,700 units kind of will take care of my 4,700. If I do, it will kind of take care of 8796. It turns out to be 8,800. That's a rounding off part. 4,700 units is the minimum volume required for me to justify this project. So minimum volume of sales is the level at which NPV is going to be 0. So you can complete this.